Well, Ashwini Agarwal joins us now. Let's take the conversation forward. Ashwini, fantastic to have you back. Thank you for joining us. Ashwini, for a market which was struggling to find the rhythm, the brute force of liquidity is so strong that you cannot put a foot wrong. Look anywhere, left, right, center, it's a sea of green right now. Do you think the gains and the insatiable appetite, which is now there for Indian equities, is back? But more importantly, is it here to stay?
Morning, Nikunj. Interesting question. We saw obviously record flows in November from overseas. We are seeing reports from pretty much all retail brokerages or even CDSL saying that the number of new accounts, number of new folios continue to increase. And this is in face of fairly significant redemptions from mutual funds. So yes, while the market is on a tear and everything seems to be good, there is an element of, I would say, somewhat excessive optimism that's starting to feed through. There are fundamental reasons behind it. I mean, we do have, COVID cases, at least in India, turning out to be quite manageable. We don't really have a second spike, despite the winter setting in and despite the Diwali festivities. Inoculation should be available in the next few weeks, as per our Prime Minister. So obviously there is reason to be optimistic. But at the same time, just looking at the strength of the rally, the gains in the stock prices, the kind of stocks that are now attracting investor attention, I can't help but feel a little bit cautious that one has to wait for a breather for the traditional investors to become interested again. But that's my caution. The fact is that the RBI last week said pretty much in Mario Draghi style, they will do whatever it takes to get the growth to become broad-based. If liquidity remains ample and interest rates remain low, who knows? I mean, the market could have new highs ahead of us.
How does one differentiate between momentum and fundamentals in this kind of a market? When liquidity comes, it does not differentiate. There is a price which you pay to buy an underlying asset, but if there is liquidity, there is momentum. So I'm sure it's a question which everybody wants to understand, that how much of the current market action is only momentum and it will fizzle away or it will fade away.
Nikunj, fundamentals, momentum, liquidity, there are multiple facets of, what drives the market. And it's very difficult to separate one from the other. If you are a very, very strong fundamentals-oriented person, you may argue that the rally in the PSU banks, for example, that we saw yesterday is completely unwarranted because these banks, have very large loan losses to provide for and so on and so forth. You could, on the flip side, from a fundamental perspective, argue that these banks are trading at price-to-book ratios which have never been seen in the history of their trading. And you could also argue that even if you adjusted the book value for all the losses that could potentially come through, the price-to-book values are still relatively attractive. So I have started to, try and become a more considered in my approach. You have to take everything into account. Momentum kind of comes and fades. That's how things are. That's just like, people buying and people selling. And you have to build an investment case to convince yourself that you want to own a security, whether it's for a few days or a few months or a few years. It depends on who you are.
The market, Ashwini, is showing signs of opening up in the industrial space, in the cyclical space. If a company like Ultratech is talking about increasing India's cement capacity by 10%, it means that they feel confident about the capex recovery and the domestic recovery. What is the best way to look at this market? Go towards cyclicals because the capex drought is getting over, or one should go back to IT and pharma, which in a sense have been the original leaders which started springing up back to life in the month of April and May?
So, Nikunj, I am somewhat cautious to expect that investment demand will take off in a significant way. The government is pushing the PSUs to spend as much as they can, but the government itself doesn't really have much money to spend. The private sector is spending in a few areas. Pharmaceuticals, for example, companies are investing money. But in large swaths of the private sector, we are not seeing signs of significant capex pickup. Ultratech, yes, announced plans to expand capacity in a significant way. But if you look at the long-term history of Ultratech, they are also very sensitive to their market share. And maybe they're just preparing for potential gains 2, 3 years, 5 years down the line in the market, and they don't want to cede any market share for want of capacity. We must also remember that companies tend to have a much longer investment horizon than financial investors. And to read, into Ultratech's decision as a revival of private capex in the near term might be a very difficult thing to do. For financial investors, including ourselves, I think that 2 to 3 years is the max that we can look out into. It's very, very hard to take a 5-10 year view of things. But as a corporate, when you're putting assets into the ground, it's a very different situation.
Okay, fair enough. I want to talk a little bit more about the banks, Ashwini, and really the kind of potential you see both on the private sector names as well as the PSUs, because that's where we've started to see traction. And if we're looking at this broader recovery that's going to play out over the next few years, would you continue to look at the financials as the overarching portion of the portfolio, or do you see a little bit more balance coming in with other opportunities in the market?
Actually, I'd like to dovetail this to the question that Nikunj asked earlier. The one way that pretty much all of us can play an industrial recovery potential is through the banking system. If the industrial recovery is to come down the road, which is not visible today, but of course, who knows, it can come through, then financials would be an excellent way to play that, because these stocks are still trading at reasonable valuations. Asset quality will definitely pick up if the industrial investment demand is to come through. The stress on account of COVID-19 appears to be lower than what was initially feared, and liquidity continues to remain in plenty, and that helps the liability side in a big way. Now, whether you want to go down the quality curve or go up the risk curve and want to embrace PSU banks, and among them which PSU banks, that's entirely one investor's view versus another. I think obviously PSU banks, history tells us that they tend to have much higher NPLs and they tend to have other challenges as well. But at the same time, one has to accept that the valuations are also extremely attractive at this point in time. So if there is liquidity and if there is a tailwind behind the sector, I wouldn't be the one to say that, avoid PSU banks, especially if you're looking to trade short-term momentum. That's not to say that we would necessarily do that, but it's just a point of view I'm expressing. And Nikunj had also asked, is it, over for IT and pharma? And I don't think so. I think, IT and pharma, in my sense, are structural stories. At least for the next 3 to 5 years, there is going to be a significant amount of business opportunity for them. Valuations are not as attractive as they were 6 months ago, but I think investors can expect returns which are equivalent to at least the earnings growth in most of these companies. And most of these companies will report earnings growth anywhere from 15% to 25% per year, and which is not a bad return to aspire for.
So, Ashwini, that's a very fair and balanced view that you've outlined. Tell me, in terms of near-term challenges then, apart from maybe moderating expectations on returns going forward, given the kind of valuations that we're trading at or earnings growth that we're looking at, are there any hindrances as you see it, any major challenges that you at least see a period of steady returns, let's say over the next year or so?
Aisha, if you think about it, the challenges are obvious. Number one is that COVID second wave is raging in the West, and even though inoculations have started in the UK and probably will start in the US shortly, it will take a while for a large number of the people to get vaccinated. There are challenges out there from a health perspective. You have a new administration in the US. Their economic policy and their policy outlook is still to be seen. The markets are at all-time highs all over the world. So who knows? You could see a global sell-off, and that's a risk that will not spare India, at least in the short run. So that's one big worry. What happens elsewhere in the world? The second one, closer home, is that I think the debate between the revival in demand being a result of a pent-up demand, or there is going to be a continuance of the kind of momentum that we've seen in demand over the last 3-4 months in the next 12 months is something that remains to be seen. I mean, anecdotally, I know a lot of small and medium-sized businesses who have done fairly poorly over the last 6 months. But India is also a country where small businesses have always been able to pull themselves up by their own bootstraps, and they have an amazing amount of resilience. So I'm hoping that this time again, just like what we saw after demonetization, just like what we saw after imposition of GST, the medium and small scale enterprises that have borne the brunt of the COVID slowdown will also be able to come back, as strongly as they did in the previous 2 rounds. So that's just a hope. We don't know if that's the case. And if you read RBI monetary policy minutes, that's exactly what the RBI governor alluded to, that we need to see what appears to be pent-up demand to turn into a much more broad-based recovery. And I don't think the answer is apparent right now.
Tactically, Ashwini, I know we're discussing the cyclical recovery and the economy-linked sectors, but do you think once again it will be Indian consumption which will sail us through from this pandemic as it did back in the 2008 crisis? And I'll tell you why I'm asking this. Because just yesterday we had a good 1 hour of in-depth discussion with some of the home improvement companies. I mean, everyone from Asian Paints to Berger Paints to Century Ply to Kajaria Ceramics, and they're sounding very upbeat. And not just on the back of rural recovery, but they're saying that, the pent-up demand is going to very well continue through the next year as well. And the second half of the fiscal is what they're extremely bullish about. Do you think as a category, it's consumption largely that you need to have your large exposure to?
Well, the consumption in the categories that you mentioned, which is typically relating to home improvement and investment in new homes, sounds logical because there has been a significant amount of government focus on reviving demand in housing, especially low-priced housing. And as you know, if you invest money into a new apartment, you would like to put the furniture in it, the tiles that you like, and so on and so forth. So I'm not surprised that these companies are starting to see the benefits of that demand. The question again is that, how long will this demand sustain? Cost of ownership or cost of purchase of a new apartment in terms of EMI relative to income levels is probably the lowest that we've seen since 2002, maybe 2003, after which we saw a significant real estate rally. So is this going to be a repeat of that time again? I don't know. 2008 is a different comparison because in 2008, the corporate debt level and the corporate health levels were at a very, very different level. Number two, the fiscal deficit and the government indebtedness was much lower than what it is today. If you remember, 2005, 2006, 2007 were years when tax collections surprised on the upside and fiscal deficits were very, very low. So there was a possibility for the government to spend a lot of money, which it did. And which, of course, didn't end up creating the supply side response that we would have hoped for, which resulted in inflation and the taper tantrums and so on and so forth. So that cycle, 2008 to 2010 cycle, is a very different cycle because this time around the government doesn't have as much firepower. Do the consumers have enough firepower? I think yes, but again, it is a cautious yes, because I wouldn't want to extrapolate what we are seeing from home buyers, what we are seeing from autos into the rest of the economy, because I'm cognizant of the fact that a large number of people have seen cuts in wages, seen losses of jobs. But at the same time, people have also cut back on expenses on eating out or travel or entertainment, which is a forced cutback. So as the economy limps back to normal, some of those areas of expenditure will go back up. So, I don't know. It's not a very clear picture, unfortunately.
Sure, I get the point. The other theme, Ashwini, that we often talk about is whether you need to now take a look at some of the contra themes. I mean, going by the social media feeds, just about everyone's holidaying as though, there was never a pandemic, or for that matter, wedding festivities are going on as was the case pre-COVID as well. Do you look at aviation? Do you look at hotel stocks now? Do you look at these contra themes, multiplexes, and especially aviation now that they've been allowed to fly at 80% of the pre-COVID capacity?
Aviation and hospitality, will come back eventually, because there is a need. There is a wanderlust among all of us, and we've been denied that for almost a year. All of us, my friends, family, everybody's itching to go someplace if they haven't already done so. So I think travel will come back. Multiplexes is a more difficult one, because the ability to entertain yourself at home through very high quality content, and with the bandwidth being available to download high quality movies and shows, has somewhat changed the way we consume entertainment. Yes, in a country like India, where there are very few outdoor places to go to, shopping and cinema becomes kind of a place that you go away from home, not necessarily for entertainment. So probably some footfalls will come back. But will they come back in the same amount of strength as we saw prior to the pandemic? I don't know. Also, I think that, by regulation, cinema halls will require to maintain social distancing, at least for some time to come. And that has a significant impact on their operating leverage. So you could argue that 2 years from now, they'll all be back to normal. And, what is 2 years when you're building a 30-year DCF? And that's an argument I hear very often. But, I would like to separate the travel and hospitality from, near at home entertainment, if that's the term to use, because of the way I perceive things.